Slide number 3, the engine risk pooling and mutuality in many Indian neighborhoods. People have groups where everyone puts in a little money every month. When one person has a big expense like a medical bill or a repair, they get the money from the collective pot. This is the simplest way to understand the engine of insurance. It is a system of neighbors helping neighbors through a shared fund. The core engine is the principle of mutuality. Thousands of people pay a small amount called an individual fund or premium to an insurance company. The company puts all this money into one big pool of funds. Out of those thousands of people, only a few will face a disaster like a house fire or a flood. When that happens, the company takes money from the pool to pay for that person loss. This is called claim settlement. The many people who were safe helped the few who were unfortunate. However, the company cannot insure everything. There are four insurable risk criteria that must be met. First, the event must be fortuitous, which means it must be accidental and not intentional. You cannot set your own house on fire on purpose. Second, the loss must be definite, meaning it must be measurable in money. Third, we need a large number of similar people in the pool. This is the law of large numbers, which makes the future predictable for the company. Finally, the insurance cannot be against public policy. You cannot get insurance for something illegal. The main point of this concept is that insurance is a massive group effort. A large group of people shares a small certain cost so that no single person has to face a huge uncertain disaster alone. Now that we see how the pool works, let us talk about the risk that makes people want to join the pool in the first place.